Hi everyone, welcome back to our channel. Today we are diving into some major developments in tech and finance that are shaping the global landscape. Let's get started. First up, Huawei has unveiled its most powerful AI chip cluster yet, the Cloud Matrix 384. This system is designed to replace banned Nvidia products and connects 384 Ascend 910C chips using cutting-edge optical networking. It's already operational in major Chinese data centers. While individual chip performance may not match Nvidia's GB200, the overall computing power and memory capacity reportedly exceed the NVL72. Priced at $8.2 million, this system is a response to the growing demand for AI hardware amid US export restrictions, showcasing China's push for self-reliance. However, it does come with challenges like high energy consumption and complex software integration. In finance news, Goldman Sachs has issued a warning about the US dollar's continued weakening as BRICS nations diversify their financial strategies. FX head Kamaksha Trivedi predicts that major currencies like the euro and yen will rise due to geopolitical shifts and de-dollarization efforts. While BRICS alone may not dethrone the dollar, their coordinated moves, including alternative payment systems, are reshaping currency dominance. The decline of the DXY index and increased demand for safe haven currencies suggest that pressure on the greenback will intensify, especially if US economic data falters. Goldman even sees the euro potentially surging back to the 130s range. In a surprising turn, China has lifted a hefty 125% tariff on US ethane, easing pressure on petrochemical firms and hinting at a possible thaw in trade relations with Washington. This unannounced waiver impacts key exporters like enterprise products and importers such as Sinopec. China, which accounts for half of US ethane exports, aims to alleviate industrial strain and mitigate the economic fallout from ongoing tariff battles. This move could provide crucial relief for Chinese industries and a lifeline for US shale producers, as broader trade talks show signs of reopening. Next, Apple is shifting most of its US-bound iPhone production to India, responding to Trump-era tariffs on Chinese goods that are impacting its profits. Vietnam will now handle US orders for iPads, Macs, and wearables. CEO Tim Cook describes this realignment as a strategic hedge against US-China tensions. Apple has warned that tariffs could cost them up to $900 million this quarter. Despite these challenges, Apple and Amazon have reported strong revenue growth, showcasing resilience among US tech giants. Finally, corporations have issued a record $100 billion in short-term debt this April, far exceeding pre-pandemic averages, according to JP Morgan. This surge reflects a rush to secure liquidity amid economic uncertainties from new tariffs and market volatility. Tier 1 paper led the charge with $66 billion, particularly from energy and industrial firms. Analysts suggest this trend indicates precautionary cash hoarding in response to policy and geopolitical risks, with current valuations appealing to yield-seeking investors. Let's take a look at the economic indicators for this week. We start with the S&P Global Services PMI for April, which came in at 50.8, slightly below the forecast of 51.4 and notably down from 54.4 last month. This suggests a modest cooling in service sector activity. On the flip side, the ISM non-manufacturing PMI surprised to the upside, rising to 51.6, above both the 50.2 forecast and the previous 50.8. This points to renewed momentum in the services economy. Now, on to inflation signals. The ISM non-manufacturing prices index jumped to 65.1, well above the forecast of 61.2 and up from 60.9 previously. This indicates intensifying price pressures in the services sector, a red flag for persistent inflation. The March trade balance showed a deficit of $140.5 billion, wider than the expected $136.8 billion, and significantly worse than February's $123.2 billion. This increase could signal weaker exports or stronger imports, potentially weighing on GDP growth. The 10-year note auction saw yields fall to 4.342%, down from 4.435%, suggesting increased demand for government debt, possibly due to rising risk aversion or expectations of rate stability. US crude oil inventories dropped by 2.032 million barrels, exceeding expectations. While this is a smaller draw than the previous 2.696 million, it still suggests strong demand or tightening supply, which could support higher oil prices. March's consumer credit rose by $10.17 billion, beating forecasts of $9.8 billion, and a major turnaround from February's rare dip of negative $0.61 billion. This reflects robust consumer confidence and spending, though rising household debt is something to watch. As expected, the Federal Reserve kept interest rates unchanged at 4.50%. This steady stance suggests a cautious approach amid mixed economic signals, balancing persistent inflation against signs of cooling growth. Initial jobless claims came in at 228,000, slightly lower than the 231,000 forecast, but up from 241,000 the prior week. While not alarming, this could hint at early signs of softening in the labor market. Lastly, the 30-year bond auction told a different story, with yields ticking up slightly to 4.819% from 4.813%, possibly reflecting lingering inflation concerns or softening demand for long-term bonds. Next week, market attention will be focused on key economic indicators and earnings reports, including month-over-month core CPI, crude oil inventories, month-over-month core retail sales, month-over-month PPI, and initial jobless claims. Meanwhile, several major corporations are set to release their earnings reports, including JD.com, Sea Limited, Cisco Systems, Walmart, Dia & Company, Alibaba Group, Fox Corporation, Monday.com, Applied Materials, and Take-Two Interactive Software. That's a wrap on today's updates. So, what does it all mean? Mixed signals across the board. Services are holding on. Inflation is still a concern, and the Fed is watching closely. What do you think about these developments? Let us know in the comments below. Don't forget to like, subscribe, and hit that notification bell for more updates. Thanks for watching, and we'll see you next time.